The world's first mutual fund. How a crisis changed the world of investing? A cold evening in the year 1772, fear suddenly began to spread in the market of Amsterdam. One after another, merchants were becoming unable to make payments, and years of accumulated wealth was getting stuck in papers. Some families had put their entire savings into a single company, bank or loan. When the crisis deepened, they understood that one wrong investment could wipe out a lifetime of hard work. Amidst this very fear, a question arose in the mind of a Dutch merchant. Could a method be created in which a person with small capital could also invest their money by dividing it across multiple places? That person's name was Abraham van Kettwich. In some modern articles he is also written as Adriaan van Kettwich, but in old financial records and prominent historical research the name Abraham is found. The idea he thought of appears very common today. Collect the money of many investors in one place and spread it across different securities instead of betting it on a single investment. But 251 years ago, this thinking was nothing short of a financial revolution. Back then there was no mobile application, no SIP, no online KYC and no daily visible NAV. At that time, investing was primarily the world of wealthy merchants, bankers and large property owners. An ordinary person did not have the capital or information required to invest money across different countries and securities. Trade had spread rapidly in Europe. Ships carried goods to faraway countries and governments and trading businesses issued bonds and other debt instruments for their needs. A good interest could be earned from these investments, but the risk was also big. A government could stop payment, a plantation could fail, and a trading company could suddenly collapse. The financial crises of 1763 and then 1773 caused big losses to the investors of the Netherlands. The impact of the collapse of the British Air Bank reached the Dutch banking house Clifford & Sons. Many investments were interconnected. When a default happened in one place, its impact spread to other lenders and merchants. Exactly like how a weak link breaks the entire chain. Van Kettwich did not see just ruin in this crisis. He saw the danger of concentration. He understood that the problem was not making an investment, but tying all hope to a single place. He thought, if 100 people pool their limited money, they could have a large pool. That pool could be invested in multiple bonds and loans. With this, the entire money would not finish upon a default by a single borrower. The interest received from the remaining investments could reduce the impact of that loss to some extent. With this very thinking, an investment fund was created in Amsterdam on the 1st of July 1774. It was named Eendracht maakt macht, which meant unity creates strength. This name was not just a catchy slogan. The entire business model of the fund was hidden in it. The capital of a lonely investor was small, but together that same capital could create a diversified portfolio. Today it is called the world's first mutual fund. In more precise language, this was not a modern, open-ended mutual fund, but a vehicle like a professionally structured closed-end collective investment trust. Closed-end meant that the fund issued participation certificates in a predetermined number. Unlike many of today's mutual funds, an investor could not buy a new unit from or redeem it with the fund house whenever they wanted. The fund was divided into different classes. In each class, 100 freely transferable bearer certificates were kept, in which the nominal value of every certificate was 500 Dutch guilders. It is not possible to convert the 500 guilders of that time into today's rupees or dollars absolutely accurately. The structure of income, purchasing power and currencies was completely different from today. Therefore, it would be wrong to claim that anyone could invest in that fund with just a few modern rupees. The amount must not have been small even then for many laborers. Still, compared to building a diversified portfolio by oneself, this entry was more accessible. An investor did not need to raise massive capital to buy every foreign bond separately. There was a plan to issue a total of 2,000 participation certificates in the fund. Investors holding these certificates could get a share in the income generated from the pooled portfolio. The main focus of the investment was not shares, but bonds and loans. Following the recent financial crises, many investors had become nervous about shares and speculative trading. The portfolio included debt securities of different European governments, banks, and foreign borrowers. Some exposure was also present in plantation loans and investments connected with European colonies. There is an uncomfortable historical reality here as well. 18th century European finance was connected with colonial trade and the plantation economy, which also included the system of exploitation and slavery. Therefore, while understanding the financial structure of this innovation, it would not be proper to hide the ethical truth of that era. The early history of modern diversification was not built in a completely innocent economic world. 𝐼 made clear investment rules for the portfolio. The capital was to be divided into different categories, so that the impact of a single country, borrower or security remained limited. In today's language, this thinking was close to asset and issuer diversification. However, the portfolio was not as broad as modern equity, debt, gold, and international funds. At that time, thousands of listed companies were not available. Therefore, diversification meant primarily spreading risk across different bonds, geographic regions, and debt issuers. An attempt was also made to keep management and supervision separate in the structure of the fund. Two commissioners oversaw the investments, while 𝐼 handled the administration. The objective of this separation was to reduce conflict of interest. An effort was made to avoid giving money, the investment decision, and complete control into the hands of a single person. An arrangement of annual accounts was also kept for the investors. This arrangement was limited compared to today's disclosure standards, but it was an important step in the direction of transparency at that time. The fund received interest from investments, and after fixed expenses and management-related payments, the income could be delivered to the participation holders. Here, it is necessary to understand another difference from a modern mutual fund. Today, the value of fund units connects with the net asset value of the portfolio, and regular disclosure happens according to regulations. In 1774, real-time pricing was not possible. Information on foreign bonds arrived at a slow pace, and communication was dependent on ships, letters, and physical records. If a war started in a faraway country, a government stopped payment, or the income from a plantation fell, the investor in Amsterdam could find out about it much later. The real importance of diversification became visible in this very uncertainty. 𝐼 was not giving a guarantee of return. He only wanted to stop a single loss from becoming the ruin of the entire portfolio. This is the very thing that many investors misunderstand even today. Diversification does not eliminate risk. It only reduces the dependency on a loss arising from a single investment. If the entire bond market falls, multiple countries default, or a global crisis arrives, a diversified fund can also go into loss. 𝐼 did not become a guaranteed success story. Political instability, wars, and changes in European markets affected its performance and growth. The Fourth Anglo-Dutch War and later major political turmoil in Europe put pressure on international trade and financial securities. During the French period, trade restrictions also affected the Dutch investment market. That revolutionary idea remained present, but the fund could not become popular on a large scale. Finally, in 1824, approximately 50 years after its establishment, 𝐼 was liquidated. The world's first fund could not become a company that lived forever. But the strength of an innovation is not measured only by the lifespan of its founder's company. Many times the experiment ends, but its idea changes the centuries to come. 𝐼 also created a second fund in 1779 under the name Concordia Res Parvae Crescunt. Its investment rules are said to be more flexible compared to the first fund. Their model reached other financiers of the Netherlands. Going forward, different forms of collective investment vehicles began to appear in other parts of Europe. In 1868, the Foreign and Colonial Government Trust started in Britain. Its objective too was to give diversified exposure in different government securities to relatively small investors. This trust exists even today with a changed name and structure. It is counted among the oldest surviving investment trusts in the world. The idea of collective investment later reached the United States. In 1893, closed-end structures like the Boston Personal Property Trust moved pooled investing forward in the American market. Then in 1924, the Massachusetts Investors Trust started. It is generally counted among the first modern open-end mutual funds because its units could expand or redeem along with capital demand. This change was very important. Instead of waiting for another buyer, the investor began to get more convenience to return units according to the structure of the fund. But the Wall Street crash of 1929 exposed the weaknesses of investment funds as well. Investors suffered heavy losses due to excessive leverage, poor disclosure, and speculative products. Following this, securities laws and the regulatory framework were strengthened in America. The Investment Company Act of 1940 created important standards for the operation, disclosure, and investor protection of funds. With time, equity funds, bond funds, balanced funds, money market funds, and index funds came forward. Every innovation connected pooled investing with a different objective. In the 1970s, index investing raised a new question. Should a fund manager constantly try to beat the market, or is it better to follow a market index at a lower cost? Later came exchange-traded funds, meaning ETFs, in which the features of a diversified portfolio and stock exchange trading combined together. Technology delivered that idea to the mobile screen, which had once started with paper certificates in an office in Amsterdam. Now an investor can put money into a mutual fund through a small monthly SIP. Their contributions become part of a large portfolio along with the money of other investors. The institutional beginning of the mutual fund industry in India happened with the establishment of the Unit Trust of India in 1963. UTI's first scheme, Unit Scheme 1964, was launched the following year. Public sector mutual funds arrived after 1987. The entry of private sector funds in 1993 and SEBI regulations began to increase choices for Indian investors. The comprehensive SEBI mutual fund regulations of 1996 prepared a detailed regulatory structure for the industry. With time, requirements for disclosure, valuation, and investor protection also developed. Today, schemes of equity, debt, hybrid, solution-oriented, index, and many other categories are available in India. But the risk, cost, and investment objective of every scheme is different. By June 2026, the total assets under management of the Indian mutual fund industry had reached approximately 82 lakh rupees crore, and investor folios were recorded at around 28 crore. These folios are not the number of unique investors, because a single person can have different folios across multiple schemes. Therefore, folios and individual investors should not be considered the same. In a modern mutual fund, an asset management company handles the portfolio, a trustee monitors the interests of investors, and a custodian handles the responsibility of keeping the securities safe. The investor gets units, and the value of each unit is connected to the NAV of the fund. The NAV can go up or down when a profit or loss occurs in the portfolio. An equity fund invests in the shares of companies, therefore market volatility can be higher in it. A debt fund invests in bonds, but interest rate and credit risks remain in it too. A hybrid fund mixes equity and debt. An index fund tries to track a chosen index, but the return is not exactly identical due to tracking error and expenses. An SIP is not a separate investment product. It is a method of investing a fixed amount regularly at a set interval in a mutual fund scheme. An SIP does not give a guarantee of protection from market loss. It can make investing disciplined and gives an opportunity to buy units at different prices. A mutual fund also does not mean a guaranteed return. The name of the scheme, the high return of the previous year, or the recommendation of an influencer does not decide future performance. An investor should understand the objective, riskometer, expense ratio, exit load, portfolio, and investment horizon. A decision should not be taken based merely on promises like, become a millionaire from small savings. The biggest lesson from 𝐻𝐸𝐺𝐥𝐵 is not to buy a particular fund. His lesson is that the risk which you cannot handle alone can be spread thoughtfully. But diversification should also be done wisely. Buying 10 funds of the same type does not necessarily give real diversification because their portfolios can match closely with each other. The idea born in Amsterdam 251 years ago has become a part of the retirement, education, and wealth planning of crores of people today. At that time, the certificate was written by hand. Today, the transaction happens in seconds. At that time, news arrived by ship. Today, the market is visible live on a smartphone. Even so, the oldest weakness of the investor has not changed. Greed tells them to put a lot of money in one place, and fear forces them to sell everything when the market falls. The real legacy of the world's first mutual fund is not a guaranteed profit, but a simple warning: the future is never certain. Therefore, do not tie all your hope to a single investment. A financial crisis had given this idea to 𝐻𝐸𝐺𝐥𝐵. His fund eventually ended, but the thinking of unity makes strength lived on in the financial world. Today, when an ordinary investor starts a small SIP, perhaps they do not realize that this option visible on their mobile is the next chapter of a 251-year-old story. This story shows that big financial inventions are not always born out of the joy of a bull market. Many times they take birth amidst bankruptcy, fear, and the broken savings of people. And perhaps this is the biggest wonder of the investment world. The very idea to which a crisis gave birth is showing people the way to understand risk and build capital together for the future today.
If this video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible, but in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.